Namaskar. This is Akhilesh Bharga. Welcome to Tit-Bits on Business and Finance with me. It was yet another MPC meet of the Reserve Bank last week, and as was widely expected, there was yet another repo interest rate hike of 50 basis points by the Monetary Policy Committee. The RBI has now been consistently increasing interest rates since May this year. It has increased the repo interest rates on 4 occasions so far, such that interests have risen by 190 basis points to 5.9% now, which is a 3-year high. And going by the assessment and discussions of the MPC and also the statements issued by the US Fed, this is not the last rate hike, and a few more are still in the offing. Depending on the unfolding trajectory of inflation in the coming months, both in India and globally, and continued interest rate hikes by the US Fed, further interest rate increases by the MPC are certainly imminent. A few more interest rate hikes by the MPC, according to us, are certainly on the cards as the MPC pursues its primary objectives of inflation control and growth, with its present focus being mainly on price control, and that explains the multiple rate increases that we have seen in the past few months. While the interest rate hikes are meant to curb inflation, which at 6.9% remains far above the Reserve Bank target of 4% with a tolerance band of plus minus 2%, the timing and extent of interest rate increases, however, is being influenced largely by the interest rate hikes by the US Fed, which has been rapidly increasing its interest rates as it seeks to tame record levels of inflation in the US. Unlike in the case of the European Union and in the case of the United Kingdom, which were late in recognizing the need to match their interest rate hikes with that by the US, the Reserve Bank, on the other hand, has been quick to do so and has thus kept pace with the US Fed in the matter of rate hikes. With each rate hike by the US Fed, the dollar only becomes stronger, and others, including India, are forced to follow suit in order to prevent depreciation and volatility of their own currency and to curb a further price rise. That's the reason why we see that while the US Fed keeps increasing interest rates, even other economies, other nations are forced to do so. Experts say that India's repo rates, which stand at 5% now, could go up to 6.5% by March 2023, expecting that prices would have started cooling by then, thus negating the need for further rate increases by the MPC. Since experts say that it will take at least 2 to 4 years to tame global inflation, it means that interest rates are bound to remain high and elevated in the coming years, not just in India, but worldwide too. With the Ukraine war only escalating and showing no signs of subsiding, the commodity prices remaining high, the latest sabotage of the undersea gas pipeline which supplies Russian gas to the EU, with all these factors, it clearly implies a tough time for the US economy, and that the global economic scenario because of all this will continue to remain uncertain and unstable. We are going to see elevated commodity prices. We are going to see disruption of gas and fuel supplies to the EU. We are going to see the EU in a recession mode, and global economy is going to remain uncertain and unstable. Even though the Indian economy has been relatively stable amidst all this, and it is considered to be a rising star amidst the global economic uncertainty, as the Deutsche Bank CEO says, the fact, however, is that it is a highly uncertain and evolving situation for the Indian economy too. We cannot remain disconnected with the global economy totally. The MPC thus reviews the evolving global and Indian economy, and it calibrates its outlook and interest rates in order to tackle the buoyant inflation. Since the time the COVID pandemic crippled the global economy and thereafter the Ukraine war disrupted its recovery and pushed it into a recession, the Monetary Policy Committee has been seized of the most extraordinary and unprecedented crisis factors in dealing with its twin objectives of growth and price control. COVID was unprecedented. The Ukraine war also was unprecedented. And it has been dealing with these factors while it decides the MPC policy. The new crisis, or the third storm as it is being called, which has rattled the global economy and which the MPC now has to deal with, is the sharp hikes in interest rates by the developed nations, which compel other nations to follow suit. The US has been the leader here. While explaining the evolving situation due to this, the Reserve Bank governor after the MPC meet said that the world is in the eye of a new storm, he says. The recent sharp rate hikes and the forward guidance about further big rate hikes have caused a tightening of financial conditions, extreme volatility, and risk aversion worldwide. He says that there is nervousness in financial markets with potential consequences for the real economy and financial stability, and of course, not in the best of terms, with an unfavorable situation. He then says that despite the unsettling global economic scenario, the Indian economy remains resilient. The RBI governor further says that the overall stress on the global financial system has become much more in the aftermath of monetary tightening. He says that nobody is blaming anyone, but we have to deal with the spillover of the monetary tightening that has been taking place in the US and the interest rate hikes, which is impacting economies worldwide. As we said, India is no exception to it. It is these developments which influence the Monetary Policy Committee to increase the interest rates by 50 basis points and to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. The MPC is not expecting the inflation to come down suddenly, but then these are calibrated measures to bring it down within its target range. The main considerations of the MPC underlying the decision to increase interest rates were: the first consideration, it says, is that the global economic activity is weakening under the impact of the protracted conflict in Ukraine and the aggressive monetary policy actions and stances across the world. It says that as external demand deteriorates, the macroeconomic outlook is becoming increasingly adverse. The MPC then says that as far as the Indian economy is concerned, its GDP grew by 13.5% year on year in the quarter ended 30th June 2022. On the demand side in the Indian economy, urban consumption, it says, is being lifted by discretionary spending ahead of the festival season, and rural demand, according to it, is gradually improving. The MPC then says that investment demand is also gaining traction as reflected in rising imports, domestic production of capital goods, steel consumption, and cement production. The overall outlook, according to the MPC, is that high and protracted uncertainty surrounding the course of geopolitical conditions weighs heavily on the inflation outlook. Commodity prices, according to it, have softened and recession risks in advanced economies are rising. Everybody knows that the EU and the US are headed into or are already probably into recession. It further says that elevated imported inflation pressure remains an upside risk for the future trajectory of inflation, amplified by the continued appreciation of the US dollar. According to it, the outlook is fraught with considerable uncertainty given the volatile geopolitical situation, global financial market volatility, and supply disruptions. So it keeps emphasizing on the instability and uncertainty which is there in the global economy and which impacts India. It then says that meanwhile, the domestic economic activity is holding up well and is expected to be buoyant in the second half of this financial year, supported by the festive season demand amidst consumer and business optimism. With this outlook and with this consideration, the MPC is therefore of the view that further calibrated monetary policy action is warranted in order to keep inflation expectations anchored. The general approach of the RBI MPC therefore has been to increase interest rates and to contain money supply in order to tame inflation, which matches with what all other central banks are currently doing in other major economies, including the US, the EU, and the UK. This kind of a policy stance of continuing to raise interest rates raises numerous issues, and that is what is the main point of discussion today. The first issue raised is, have interest rate hikes so far helped to curb inflation? That's the first question. Inflation remains elevated and rising despite 4 interest rate hikes since May this year. But then, inflation does not dip immediately after a rate hike. There is a time lag of 6 to 8 months before its impact sets in. So the earliest that we will see the impact of interest rate hikes on inflation is by December 2022. On the other hand, the rate cuts are helping to keep the rupee relatively stable and to prevent its sharp slide against the dollar, which otherwise would make imports much more expensive and would bring in further loads of imported inflation to India. A 5% depreciation of the rupee versus the dollar results in a 20 basis points jump in inflation, and thus rate hikes do help to restrain prices, but as we said, it takes time for the impact to set in. A lag of at least 6 months is expected. The second issue raised is, do interest rate hikes help to prevent a rapid rupee depreciation against the dollar? In the immediate term, interest rate hikes do strengthen the rupee versus the dollar, though that is not the objective or domain of the Monetary Policy Committee. The Reserve Bank governor said in his post-MPC meet conference that currency market fluctuations like appreciation or depreciation of the rupee are not for the MPC to consider. The third issue or question is, will demand and growth be affected because of the interest rate hikes that we are seeing? India is still witnessing buoyant shopping and spending because of the pent-up demand of the past 2 years. It is truly the first normal festival shopping after 2020 and 2021. It is thus too early in the day to say whether the current demand growth will be sustained in the coming quarters. It must be noted that despite this, core sector growth, consumer spending, and manufacturing sector growth dipped in August and September. While interest rate hikes will eventually hit demand and growth, it is the lack of jobs and rising unemployment and receding household income which will erode it even more further. The next issue or question is, will real growth suffer due to interest rate hikes? Real growth will take a hit due to rate hikes since expensive loans dissuade corporates from borrowing to invest, and they also dissuade consumers from borrowing to spend. Even the present credit growth of banks is far more because of working capital loans than on account of offtake of fresh project loans. The next issue is, should India also increase interest rates just because the US Fed does that? India will have to match the interest rates to prevent a sharp depreciation of the rupee, to minimize volatility in its currency markets, and to prevent a sudden flight of foreign portfolio investment, FDI, and foreign investment from India. The next point is, do interest rate hikes support macroeconomic stability of our economy? The answer is an obvious yes. They do help to strengthen, support, and stabilize India's macroeconomic situation. The fact is that as long as the US Fed increases interest rates, inflation remains high, and GDP growth does not dip sharply, you can expect the Reserve Bank Monetary Policy Committee to continue with the rate hikes, as it is the only option to tackle a stubborn inflation at the moment, as far as the domain and jurisdiction of the MPC to do so is concerned. This is Akhilesh Bharga signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.